Let's know some of the key terms to get a deeper understanding about financial planning. First, net income. Net income is the total profit after deducting all expenses, including taxes and interest, that provides a comprehensive measure of overall profitability and financial performance. Second, operating income. Operating income is a profit generated from core business operations, excluding interest and taxes, which reflects the efficiency and profitability of a startup's primary activities. Third, taxes are the mandatory payments to the government based on your income and transactions, affecting cash flow and financial planning. Fourth, interest. Interests are costs incurred on borrowed funds, impacting expenses and cash flow management for startup operations. Fifth, depreciation. Depreciation is the process of spreading out the cost of the tangible assets like equipment or property over its useful life, reflecting its gradual wear and tear and reducing the taxable income without involving actual cash flow. Some instructions to follow before you start using the tool. Select from the four planners in the tool based on your venture type or revenue model. If your startup isn't an exact match, choose the closest option possible. Your task is to review the planning considerations and make reasonable assumptions. Your task is to analyze the impact of your assumption on revenue growth and profitability. You need to develop profit and loss projection for the next year based on your assumptions. And finally, you need to present your learning to the class. You can access the financial planning tool in course content by going to module 9 and lesson 3. Some important instructions before you start using the tool. Select from the four planners in the tool based upon your venture type or the revenue model that you have chosen. If your startup isn't an exact fit, choose the closest option possible. You will find that each planner comes with initial description, assumptions, and figures. These are only for illustration. You must replace this with descriptions and values that are relevant to your startup. In the part A of the exercise, discuss with your team and enter values in the following 6 categories in the tool. Please note that the specifics will vary depending upon the business decisions and the primary revenue model that you have chosen. First category is decide how much you will charge your customer per unit of your product or service. For an example, subscription or SaaS business, you may charge rupees 500 monthly per subscriber. Additionally, for B2B, add the number of subscribers per customer. For a manufacturing business, you may charge rupees 550 for a t-shirt, or for a service-based startup, you may charge rupees 100 per hour of legal consultation. These are some examples for you to understand how to decide how much you will charge your customer per unit of your product or service. Second, estimate your cost of goods sold. Here, for example, if you have a subscription or a SaaS based startup, you may have to pay rupees 50 monthly on cloud based service cost per subscriber. If you have a manufacturing startup, let's say t-shirt selling startup, the cost of fabric that you have to buy may be rupees 250 per t-shirt. If you are a service provider type of a startup, the paralegal cost may be rupees 200 per hour, which you have to bear. In the next step, estimate your fixed monthly cost of salaries and administration. For example, rent and salaries are fixed cost that a startup has to incur every month. Here, for example, you may give a founder a salary of rupees 50,000 per month, or you may pay a rent of rupees 25,000 per month. These are part of your fixed cost. In the next step, estimate your fixed monthly expenses on marketing, advertising, and promotion. For example, a marketing head may be hired for a salary of rupees 1 lakh per month. Include that as one of your expenses. Or you may outsource your marketing to a social media agency for rupees 25,000 per month. This can also be your fixed monthly expenses on marketing or advertising. Next, estimate the rate at which you will grow your sales every month. For example, have a target to acquire 5% more subscribers every month or sell 10% more t-shirts every month. These can be some targets that you can set. Next, in the final step, if you take loan from financial institutions, enter the loan amount and the interest rate. Also, enter the estimated income tax rates and depreciation rates if applicable. For example, you may mention that you have taken a bank loan of rupees 10 lakh at 12% per annum interest, or you have purchased a manufacturing machine for rupees 25 lakh. In the part B of the exercise, use the information and visual display on the tool to ensure that you are making balanced and reasonable financial decisions. As even you work with the tool, ask yourself these questions. Are we basing our revenue projection on realistic, data driven assumptions, or are we overly optimistic about our growth? Ask yourself also this question. Have we accounted for all the potential costs, including hidden ones like legal fees, taxes, and infrastructure expenses? Next, ask yourself this question. Have we priced a product based upon customer willingness to pay and market research, or are we relying on arbitrary numbers? Next, ask yourself this question. Have we allocated enough budget for marketing and customer acquisition, or are we assuming that customers will find us organically? Finally, are we being realistic about how much time and money is needed for finding the right talent? Now it's time for you to do the team presentation. What you need to share as you present as a team is what is your primary revenue model? How did you decide the pricing for your product or service? What are the expected revenues? What are the expected net profits? Cost of customer acquisition? Break even month? Justify? Is the above realistic and achievable? And finally, what are the risks?